Okay, so I want to make this video explaining a couple things about index investing and why you actually should consider switching the index you're investing in. And it's fairly simple in terms of how the index is actually constructed, the internal components are, and then what those investments do on a regular basis. And understanding how the S&P 500, like if you're investing in IVV or VOO, understanding what it is rather than just blindly investing in it, because we're all taught that, hey, the average money manager can't beat the index and this and that, which I'm going to tackle that later on in this video as to why that's true but also not true. It's not really a fair comparison. Um, so for those of you that don't know, I actually am a licensed financial advisor. I've been doing this for 20 years. So when you start to actually analyze the components of the S&P 500, you begin to realize there's actually a better way of doing this that will get you a greater return, especially if you're in your 20s, 30s, 40s, 50s, even 60s, really. So when you're in your younger years, you want to be able to make more. You can always go more conservative at some point in the future. You can always go to dividend paying stocks or real estate or something like that in the future. When you're younger, you want to have the growth. You want to have 15, 20, 25% returns. And when you begin to change your index, that's really can have a huge impact in your overall portfolio. So we're going to take a look at the S&P 500 just from a component standpoint. And for me as a financial advisor, while I will always gravitate towards the triple Q rather than the S&P 500. Okay, and it really has to do with the internal components and where the money is being made in the S&P 500. So here's a breakdown by sector. IT makes up about a third of the index. And there's always this conversation about, oh, the index is so overweight with Max 7, it's so overweight in tech. That has been a conversation that's been going on for the past at least 20 years. I found an article online that was written in 2004, like right after the dot-com bubble burst, where that article was very concerned about the overweight influence of technology, and technology was only 14% of the index at that time. Okay. It's 20 years later, a little bit more than 20 years later, and now it's between 30 and 33% of the index. So that piece has doubled. Realistically, by 2045, 2050, the market will be half technology stocks. Okay. And the main reason for that and why that's an inevitability is really because of the profit margins that these companies make. Apple makes $100 billion in profit per year. Okay, 100 billion. Most companies' market cap isn't even 100 billion, so they're not making 100 billion in profit. When you look at drug companies, any industrial companies, uh, real estate companies, any of these sectors, consumer staples, communication services, probably with the exception of Meta, nobody's making profit margins like that. So over time, these companies that make these huge amount of profits begin to become overweight in the index. It costs very little to manufacture, more importantly, distribute software. Anybody can write software. You can pay a guy to write your software program or to write an AI program. That component is very, very small, and then you pretty much have a free distribution network with the internet. It's not the same thing when you're manufacturing an airplane or a tractor or railroads. There's so much more manpower, so much more materials, delays, so much more that can happen that affect that business than with technology companies. So as we progress into the future, these technology companies are just going to take up a larger and larger percentage of the market, and that's already been proven. Keep in mind, prior to 1978, there was no technology sector in the market. That's when Apple and Microsoft are kind of getting started, and they don't really become a driving force until probably the late 80s, maybe early 90s. So that's a brand new sector of the market that has now overtaken the market, and that is going to continue simply because, especially with the S&P 500, it's a profit weighted model. It's a price weighted model. So those companies that make those higher profit margins are going to continue to have a bigger and bigger impact on the overall performance of the market when we're looking at just the S&P 500. So my take is if we know where the market is going already, why don't you invest your money so that you're on the trajectory of where the market is going rather than being kind of stuck in the past? Uh, we know that these companies are going to continue to make these huge amount of profits where they make profits of 100 billion per year, you know, it's 80 billion per year that are larger per year than some other companies' entire market caps. That is going to continue. It just is going to stop, especially as we incorporate more AI into platforms, Copilot. You know, obviously, NVIDIA is a big winner in this space, along with some other companies. But you might as well invest where the market is going to be anyway. So, and I'm not saying that the rest of these sectors aren't important to invest in. What I'm saying is that in a couple years, IT is going to be 35% of the market. It fluctuates now between 30 and 33. In a decade, it's going to be closer to 40% of the market. So invest where the market is going to be, not where it was. Okay, the more money you have in the rest of these categories, I don't want to say that you're behind, but you're leaving money on the table. And a perfect illustration is something like this. So let's go to Morningstar and look up, past performances. I always will encourage everyone to do this. If you're looking at IVV or VOO is probably the more common one, just looking at the index as a whole. And let's look at the performance. Okay, the trailing returns. And then we have the averages here. Okay, so on the 5-year, we're at 16% almost. The 10 years at 12.29. What I like, here's also a side note, a lot of people will say, oh, the S&P averages 10% a year. The index itself does, but when you're looking at IVV or VOO, that's the piece that actually incorporates reinvested dividends, which is typically between 1.5% to 2% a year, which is why those yields will always be higher. So when someone comes to me and quotes, hey, the S&P normally does about 8 to 10, they're usually not including reinvested dividends. Okay, you do that, you get another 2%. But when we're looking at just performance metric, let's look at the triple Q. And again, we're just looking at straight up performance. We're not going to talk about diversification just yet. There's a way to handle that. But the triple Q is going to be a little bit more tech heavy. Again, it's already where the market is going to be when we're looking at the S&P 500. Okay, the 5 years at 17 and the 10 years at 17. Okay, the 3 years at almost 19. And the triple Q has a long track history of already outbeating the S&P 500. Okay, look at this right here. This is Invesco's website. Now this is going back to 1999, pretty long track history, but clear difference here. S&P 500 since 1999 is up 605%. The Invesco triple Q is up almost 1,000%. That's too much money to just leave on the sidelines. Okay, way too much money to just leave on the sidelines. When you're talking about the difference of getting 17% right here versus, let's go back to VOO. You've got 15 on the 5-year, but on the 10-year, you've got 12. 5% more. We complain about paying financial advisors 1% table. That doesn't make any sense. Doesn't make any sense at all. Let's look at it from a graph representation. Let's see here. Look at the S&P 500. Okay, here's the 10-year. Actually, because that doesn't include reinvested dividends, let's look at VOO. Okay, 173%. That's VOO over 10 years. Okay, and obviously you can see the dips here. These are great times to buy in. I'm going to come back to this point here, but let's just look at the triple Q. Almost 360%. It's a huge astronomical difference. When people say, oh, I don't want to pay a financial advisor 1%, but I'm going to leave 5% on the table. I'm going to leave 7% on the table by not investing in the triple Q versus VOO. You got to be kidding me. 173%, which is a killer return. That's a great return. But 173% is not 359%. It's almost double when you really break it down. It's almost double. And you have a huge advantage with the triple Q that you don't with the S&P 500. And that's when you're adding money. So let's take a look at an example. Back to VOO. When you're adding money, when you're buying those dips, we're not going to talk about the last couple months. We'll go back a little bit further because this is a longer term dip here. This is kind of bear market territory. We go from VOO being $422 a share, hitting a low point of 328. So it goes down about $100, which is a drop of about 20%. Now, here's the thing with math. If you have $100 and it drops 20%, that's $80, right? If 80 goes back up 20%, you only hit $96. You need to make 25% on $80 in order to get back to the original 100. So when you're adding money at that point, you're going to make more just by getting back to where you were. You're going to make 25% rather than the original 20% that it was down. Again, you're going to make 25% when you're adding money at that point. And that's why adding money consistently to your investments is so important, or buying those dips. But let's look at the triple Q, the opportunity that it provides. Okay. Here's the same drop. We go from 398 down to 281. Okay. 398 down to 281. And I'm going to do the math on that one. Let's see, divided by 398. That's a drop of 29%. Okay. Now, to go from 281 back to the original 394, okay, again, let's do that math. 394 minus 281. Okay, so it goes down about $113 a share. Okay. But once it makes up that $113 a share, you've actually made 43% on the way up. When you're buying here at these lower points, you've got to go back up $113 a share. 113 divided by 260 is about 43%. So when you want to make up for lost time, when you're trying to really get as much bang for your buck, the triple Q offers far more rebound potential than the S&P 500 does. Far more rebound potential. It's going to be more volatile, but if you're a buy and hold strategist, if you're somewhat of a passive investor where you're just going to set it and forget it, gravitating towards the triple Q, or even just putting a portion of your portfolio, like split up the difference, go half S&P or VOO, half triple Q, you're going to get a far better return than just investing in the IV or VOO by itself. Okay, and you need to understand that, because the triple Q is where the market is going to be, not where it's been. Take a look at just the last year, the opportunity that this provided. So we went from 539, down to, what's our low point? 416. Okay, so that's a difference where it dropped $123. But if you take that $123 and you divide it by 416, the rebound potential is so much more. Once it gets back to its original point, you're going to make a lot more, because from 539 down to 416, you're down $123. Okay, which means that market was down about 22, we'll round it up, say 23%. But if you're buying here, you basically make about 30% on the upswing. Again, this is when you're adding money, and that's so critical. The dollar cost averaging, that's fine. I will also say you need to buy the dips, because those happen, every year or so, where you can buy the dip. Adding money at that point, you're going to get a significant boost in your returns when you're looking at the triple Q versus just the S&P 500 or VOO. It's going to give you a lot more rebound potential. I know someone's going to say, well, hey, you're really heavy into the tech piece of the market, this and that. There's nothing wrong with that. There really isn't, because the tech companies are the ones making all the money anyway. If you're a passive investor, if you're a long-term investor, tech is really where the money is. Sure, you can buy other companies for a diversification piece, but what you have to realize is that part of that diversification story is a story that's been sold to you by banks, investment firms, and things like that ends up diversifying away your portfolio, diversifying away your returns. Okay. When you're focused just on growth, you really want to be looking at tech. And I'm not saying that you need to ignore the S&P or other parts of the market. What I'm saying is you can always buy those later. If you're in your 20s, 30s, 40s, 50s, more money is essential now. You can always go more conservative. Okay, but it's really tough to start off conservative and then go more risky. You're not very comfortable with it. But let's just look at the holdings of the triple Q versus the S&P 500 anyway. I'm looking at all these companies. All of these companies, look, this is about these top 10 are about 50% of the market or 50% of QQQ. I can tell you there's not a single company on this list right now that doesn't have a 10-year average or maybe even a 15-year average of earning about 20%. Okay, far exceeding that 10 to 12% that you normally get in the S&P 500. And the thing is, the majority of the returns of the S&P 500 are made by these companies anyway. Okay, it's not made by Boeing. It's not made by John Deere or Caterpillar or United Health or a lot of these other guys that are in the index. The majority of the return is made by the S&P 500, or the majority of the return of the S&P 500 is made by tech. It's not all the other guys. So you might as well just double down on what actually is working and eliminating what doesn't work. Every single one of these companies, if you look at them on Morningstar, is going to have a killer return compared to the market. Look at Costco, okay, because this is just a diversification piece. Costco really isn't tech, but it's in the triple Q. Look at those returns: 5-year 28%, 10-year 22, 15-year 21.5, more than 21.5%. It has a 15-year track history of earning almost 22%. There's not many stocks out there that do that. Very few. Okay, the triple Q is really, really, and it is tech heavy, but I'm not really worried about that because honestly, tech companies to me are safer. They generate the most cash. They have the best balance sheets. They have high margin products. And there's nothing really wrong with investing in VOO. But if you're talking about wanting to get wealthier sooner, having more financial security, retiring earlier, go to triple Q and then later on buy the S&P 500. Okay, because in this makeup here, I'm not saying you don't need financials and healthcare, but I can also tell you something. You don't need real estate. Look at this portion. Real estate, materials, utilities, and energy. So if you have 100 grand in your portfolio, if you have 100 grand in VOO, this is roughly about 10% that you really don't need. And it's also 10% of your money that really isn't working that hard. Okay, and I'm going to show you that. And the thing is, if you have 100 grand in your portfolio, you have a little over $2,000 in real estate. It's not going to affect your overall portfolio all that much. Even if that real estate piece shoots up 20%, $2,000 became $2,400. It's not going to make or break you. It's $400. Okay. Utilities overall don't really earn all that much. Materials doesn't really earn all that much. And energy, unless you're actively trading it, buying and selling, you're not going to make a ton in there. Okay. You can pull up, let's just pull up a couple of these. And I'll kind of show you what I mean here. Everybody loves Vanguard. So let's check out VDE. It's the energy sector of the market. Okay, here's the 10-year total return. Okay, 3%. That's it. Unless you were actively buying and selling, buying a lot here, maybe selling it here, rebuying it here, you made that's. And again, it's only 3% of your portfolio. It's not a big deal, but it only made 3% over 10 years. Okay, take a look at the utility sector of the market, VBU. Okay, over 10 years, it's a little bit better, but that only really equates out to be about a 7.5% return, maybe, if you average it out annualized, maybe a little bit less. And there's nothing wrong with 7%. And sure, you get a dividend yield, but 3%. Why am I focused on something that's going to earn 7% when I can focus on something that's going to do 15, or Costco, which is going to get me 22? And again, I can always go back and buy these later. Let's check out the materials sector of the market, VAW. Again, it's about a 7% return. Not too bad, but you can buy this later when you're older. You don't have to buy it now. And when you eliminate the waste, even if you just take these out, take those out, take that 10%, throw it in the triple Q, you're actually going to beat the S&P 500 over a long period of time. You're going to break even with it in the first year, maybe 2 years. But after that, you're going to diverge enough to where you're just going to consistently outperform the S&P 500 because there's so much in the S&P 500 that you don't need. so much in the S&P 500 that you don't need. Also, you have to keep in mind that because of the way the S&P 500 is structured, companies fall in and out of that index all the time. I think there's something like it's something astronomical, like 30 to 40% of the companies that are currently in the S&P 500 won't be in the S&P 500 in 5 to 7 years. Okay, they just won't be in the S&P 500 in 5 to 7 years. And the main reason being is because to be in the S&P 500, you have to be profitable for at least 2 consecutive quarters. So if you have a business that's struggling or a sector of the market that begins to struggle, and that business misses a quarter of profitability, certainly two, it's out of the S&P 500. It's not going to be in there. And overall, when you have a piece of your portfolio that's so small, like this 2% here, it doesn't really need to be in the portfolio, because even if that sector overperforms, you get 15, 20%. Again, $2,000 turned into 2,400. Focusing on the bigger pieces of the portfolio: information technology, financials, healthcare, consumer discretionary, consumer services. And I'm going to show you how to amp these up, okay? Because each one of these, you can actually juice out a little bit more. So for example, let's just start from the bottom on consumer staples. Here is VDC. This is the consumer staples ETF of the market. And 6% of your money when you buy VOO is in VDC. Take a look at the performance. Again, always look at the past performance. Past performance does not guarantee future results, but it sure can indicate them. Okay, you need to remember that. No, it's not a guarantee, but it can indicate what is going to happen. 3-year average at 6%. Okay. 5 years a little bit better at 10, and the 10 years at 8. Okay, that's not too bad. Now keep in mind, these 5-year numbers are going to be a little skewed heavy, and that's because the market just took a big dip, in 2022. So when you're looking at these averages, see how we're starting off from this low point because of COVID and then because of 2022. If you even just go back a year, the returns aren't going to be as great because you're coming off of this low point. You're coming off of this rebound from 5 years ago. You can see here, this is May of 2020. Okay, COVID started in March. So these 5-year numbers are always, right now at least, they're going to be a little skewed. After this year's over, they're going to return, they're going to drop, because now we're starting here. We're starting at the beginning of 2021. And obviously this run up isn't as much, but you get a huge run up because this is the rebound after COVID. Okay, so looking at VDC right here, this is how you actually juice the index. Because diversification, yeah, you can have it, but you don't want to sacrifice your returns. So in VDC, you can look these up. You can always go and see what the portfolio is made up of. Okay, I'm always a fan of U.S. companies. I don't like international companies. I don't think the risk reward premium is really there for national companies. But take a look at this. What's the number one holding in VDC? Costco. Makes up 12% of the portfolio. Costco. 6% of that index is in consumer staples. So my feeling is, okay, Costco is the main holding, and then followed by Procter & Gamble and Walmart. So why not just buy Costco? Okay, you can buy Procter & Gamble and Walmart too. Those don't have bad returns. But here's the thing. This performance was already it's okay to 10%. If you just go back and buy Costco, you took a section of the market that normally gets you between 8 and 10, okay? And you turned it into a 20% performer. And that's how you begin to beat the market. That's how you begin to beat the index. Okay. You don't need necessarily the rest of VDC. You can do it for diversification, but let's check out Procter & Gamble. Let's see what their returns are like. Because again, it's the top 3 holdings. Okay. You're at 8%, which is pretty common for a VDC consumer staples type of fund. I mean, it's your toothpaste and toilet papers type of stocks. Let's check out Walmart, because Walmart was in the top 3. Again, check the trailing returns. A little bit better. Okay, 3 years really nice. Again, because we're coming off that rebound from 2022. 20%, 15%, 13%. Investing in just VOO or IVV, if you rebuild the market with these sectors, eliminate the dead weight that you don't need, and then you make small concentrated positions in companies that you were going to own anyway. Again, BDC. Let's take a look at it again. 30% of it was Walmart, Procter and Gamble, and Costco. Actually, closer to 35%. So, what if you took that 6% that was going to go in BDC and you divided it up into thirds? You could do 2% in Costco, 2% in Procter and Gamble, and 2% in a Walmart. You could also just consolidate it if you wanted to go aggressive and just put the full 6% in Costco. Then you took an investment that normally gets average returns, this 8 to 10% stuff down here, and you turned it into a 20% performer. Okay, a 20%, you took a sector of the market that normally gets you 8 and 10, and you turned it into a 20% performer. Beat the market. My goal isn't necessarily to beat the market. My goal is to make as much money as possible without taking on a stupid amount of risk. To be perfectly honest, Costco is a much stronger company than Procter and Gamble. I don't know if I would consider stronger than Walmart, because Walmart is the number one grocer in the United States. But when I look at the rest of the portfolio, Coke, Philip Morris, Pepsi, Altria, Mondelez, Colgate, Palmolive. And again, as we go further and further down the list, there's less and less money being invested in those companies. It diversifies away your returns. Focus on what works. Focus on where the money is going. When I look at Coke or Pepsi, I mean, they're okay companies, but I don't really need them right now. I can buy them when I'm 70. Like maybe I buy them when I'm 60, but I'd much rather have the growth that's available to me. I'd much rather have a 20% Costco performer rather than an 8% Pepsi or Coke because I like Pepsi or Coke, or because Warren Buffett buys Pepsi or Coke, or actually more Coke. I don't really care about that. I want to make money in the safest way possible. Costco is an incredibly strong company. This is why I'll encourage anybody who's buying stocks to look up earnings reports. Okay. But you can easily begin to outbeat the market, to outpace the market when you use this strategy. Let's take another look at another sector of the market. We'll look at healthcare, because healthcare makes a bigger piece of the portfolio. It's 11% of the index. Okay, so this is going to blow your mind. So now you got 11% of the index that you're focusing on. VHT. Here's the performance. Again, we're going to look at the averages. 3%, 6%, 7.5%. Okay, it's not exactly great. I mean, it's okay, not exactly great. Now, let's take a look at what's in the portfolio. Number one company making up 11% of VHT is Eli Lilly. Let's check them out. What comes up? Oh, the 5-year return and the 3-year return are at 37%. The 10 years at 26.5 almost. The 15 years. So for 15 years, if you bought the stock 15 years ago, you averaged 23% by sitting on your ass and just owning this stock. 23%. More importantly, and I'm not saying you just buy Eli Lilly, maybe you take that 11% that was in the market, maybe you put half of it in VHT, and you put the other half of it just in Eli Lilly. But VHT was getting 6 to 8%. You just took a piece of the market that was getting 6 to 8% and turned it into a 20% performer. Don't tell me you can't beat the market. And the best part is you can just do this and sit on your ass. That's the best part. You don't need to trade it. You can buy the dips. God, do not rebalance. Rebalancing is bullshit. I'll talk about rebalancing in a second, but rebalancing is bullshit. Do not rebalance. That is the stupidest fucking thing you can do. Do not rebalance. Again, taking that piece of the market and turning what is a 6 to an 8% performer, turning it into a 23% performer. And this is just getting stronger because they just released those weight loss drugs. Okay. And here's the thing when you're doing a news comb. There was an article about Eli Lilly earlier today. Let's take a look. This was on Market Watch that was done earlier today. And when you're doing a news comb and you're looking for news on the stocks that you already own or that you're interested in buying, you want to find articles that are like this, okay, that confirm your biases almost in a way. Not just your biases, but actually raw data that is showing how Eli Lilly is so much better than the next competitor, which is Novo Nordisk, in terms of these weight loss drugs. And I've been seeing article after article about this, how Zepbound is better than Wegovy, it gets better results, you lose weight faster, blah, 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 blah. Okay. This is a competitive advantage that Lilly has over its nearest competitor. Kind of like how NVIDIA has a big competitive advantage against AMD and they sell so much more product. Whenever you're doing your newscomb, you want to find things like this. Again, this was in the market. This was in Market Watch today. So I'm also going to go back to my one of my favorite hated topics in terms of investment strategies, which is rebalancing. Don't rebalance your portfolio. So I can't remember if it was Charlie Munger or Warren Buffett who said that rebalancing your portfolio is like cutting your flowers and fertilizing your weeds. And in managing money for 20 years, I cannot tell you how foolish rebalancing is. Winners stay winners. Okay, the idea behind rebalancing is that you sell your winners and you buy some of your losers under the pretense that your losers eventually become winners. Losers don't become winners. Losers typically stay losers or very mid-level performers. Winners stay winners. They're the best of the best. And they get these huge returns and they stay there for decades. They don't typically lose ground. They are the best of the best and they get these huge returns because they are the best of the best. Do not rebalance your portfolio. I can take any portfolio and run it through an analysis, and you typically lose between 1 to 2% a year off of rebalancing. Your losers don't become winners. Very, very rarely. You're selling off gains over something that's going to continue to make money, and you're buying things that aren't making money. You could be, just look at the S&P. If you keep selling off your gains and buying your losers, you're selling off the stuff that's making money, information technology, and you're buying the things that aren't making money. That's absolutely ridiculous. Why would you do that to yourself? You're just making it harder for you to be wealthy, make money. And the thing is, rebalancing is just more activity. Sure, you can set it on auto rebalance in your 401k or something like that, or you can do some kind of software that sets it up on auto rebalance. But you got to understand, you're losing about 1% a year, bare minimum, probably. Do not rebalance your portfolio. This is one of those things, in my personal opinion, that is good marketing from investment companies and banks. And again, I worked for them for years, so I know how they work. Rebalancing is just programming you to trade in your account when you don't need to. And here's why it works. And here's the benefit to the banks. Because when you're trading, there's always a bid-ask price. Okay, meaning so that when you're selling, you're putting out an offer you're asking this certain price for it. And there's also somebody that's bidding for it. And there's always a slight difference. Okay, it could be a couple cents or something like that. And that slight difference goes to the trading firms, goes to the clearing houses, the New York Stock Exchange, whomever. Okay. So when you program 100 million people, 200 million people to actively rebalance their portfolio annually, quarterly, it's just reoccurring revenue for those investment firms. That's all it is. It's just recurring revenue. Do not rebalance your portfolio. You don't need to. If you have winners, keep betting on them. Okay, and for those of you that want to disagree, this falls right in line with Warren Buffett's strategy, Charlie Munger's strategy. You don't sell your winners. If you want to take off some cream out of the crop and go buy something like a house or some other hard asset that because you want to actually realize your gain, that's fine. But don't sell Apple and buy Boeing. Okay? Don't sell Microsoft and then buy a utility company. It doesn't make any sense. You don't worry about the overweighting risk, okay? Because that company is going to keep growing. It's going to keep going up there. That's not the problem. The problem is your behavior of going to buy your losers. And that's the main thing I want you to avoid. It's just you don't want to buy your losers. I've never seen a portfolio that benefited return-wise from rebalancing. It just doesn't exist.